Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us on tonight's show, and this is our last for the year. We have Adam Dawes of Shaw and Partners, and we're going to run through a whole lot of tech stocks that I just think are being absolutely smashed and look like fantastic value. I'll see if he agrees with me. Then we've got Jun Bei Liu of TenCap. I'll ask her the same questions and ask her for the Christmas gift that keeps on giving. And then we'll finish off with poor Rickard of the Switzer Report. I'll also ask him about the tech stocks, if I'm actually barking up the right tree or not. And we'll also ask Paul what he thinks is the stock that will give very well in 2026. So without further ado, let's cross now to Adam Dawes of Shaw and Partners. Adam, thanks for joining us.
Yeah, great to be here, Peter. Thanks so much.
Yeah, it's funny. I only saw you on Thursday, boom, doom, zoom, and I'm missing you already, mate. So it's a beautiful relationship.
Absolutely.
Enough of this bromance. I'm never good at bromance stuff, but I just did it for TV effect. All right, mate, great to see you. One thing we did discuss on Thursday, one of our viewers, subscribers, asked us about a company I didn't know much about, you didn't know much about, but Shaw and
Correct.
Partners have a pretty positive view on it. So the ticker code is MAU, and it's called
Magnetic Resources.
Magnetic Resources. So tell us what you promised and you're delivering. A man who keeps his promise, that's unusual.
That's right.
Yeah, can you tell us what you discovered?
Yeah, so look, it is actually, I should have looked at this a little bit further previously, because we were basically saying that Shaw's is basically saying that's one of our preferred developers in the exposure for gold. Okay, so Magnetic Resources, they're an exploration. They're doing some exploration updates, but they're also in the producer side or the developer side of things as well. They've got some really good results that came out of the Lady Julie North 4 project, with about 149 meters at 1.2 grams per ton, and 33 meters at 2% or 2 grams per ton. So it's actually not a bad little one. With gold, obviously higher than 1% is sort of that sort of range where you want to be. I guess what you're really looking at is basically the mine life. It's about 11.5 years. They have a milling capacity of about 2.75 million tons per annum, as well as then they've got a steady state of production. So in other words, there's lots going on there at the moment. So I think this one definitely sits in the space of a developer and some explorers. So you want to be in those spaces going forward. We've put a buy rating on it. It is a high risk stock, so it is the risk profile is high, but we've got a price target of $3.98 on it, which is
now?
We'd have to check, but I think it's around 130, somewhere around there. So
Yeah.
definitely looks like you can make something of that one. There is potential that there might be. It is an M&A target. So looking at that, just because of the quality of its assets. So I'm going to stick with my research guy, and it's a buy. AU.
A very interesting way. And let's face it, you made the point. It's high risk, but the view for gold is still very positive, isn't it? Particularly with the US dollar likely to go down, that's usually good for gold. So, yeah, for people who might be looking for a Christmas tree speculator.
There you go.
Yeah. All right. So that's Magnetic Resources.
Yeah.
Now, generally speaking, we've seen a rotation, and you and I have spoken this over a year, that we thought a lot of the top 20 stocks that went to unbelievably high prices, CBA over 190, JB Hi-Fi close to 120. They've all come off the boil, and I guess I'm going to ask you, are they getting back in the buy zone? But resources is the area that's now got a lot of thumbs up from the industry. Do you suspect this is going to be the sector for a large chunk of 2026?
Yes is the answer. Absolutely. I think you need to pick your commodities well. So in other words, I think commodities like lithium, copper, and sort of strategic minerals will be doing very well next year. I think also then you need to be a little bit careful about the bulk miners, so iron ore and coal. as case in point, Whitehaven came out today with a massive resource upgrade, which would usually send the stock up 10-20% just on the back of that resource upgrade. The stock's up 3 cents today. So that really shows to me that the bulk commodities are going to continue to struggle, where we've got the lithiums, PLS looking good over $4. Remember, that was at nearly $1 at the midway through this year. And then you've got, the mining services guys like Min Resources and those kinds of things with a little bit of lithium, a little bit of that, all starting to move forward in the right direction. So be careful on your commodities. But yes, I do think commodities will be something that you can definitely look forward to in 2026. But remember, at the start of this year, if you had just banks, you were doing very well. And if you had no banks and had resources, your portfolio was struggling, right? It was really struggling. Now we've started to see the resource stocks doing some heavy lifting, as you well pointed out, as Commonwealth Bank came off, as well as, sort of these other stocks that had run very well. So just be a little bit careful, but I certainly think you got to pick your right commodities, and there's certainly a lot to choose from. But I think commodities, if the US dollar continues to come down, should be a good year for our mining stocks.
Yeah, because lots of those resources are priced in US dollars. As the dollar comes down, they become more buyable, aren't they? Now, can we just, for the moment, you mentioned copper. You've been a great Sandfire Resources fan in your time.
Yes.
And we know it's a very good company, but it's often priced to perfection. Is there an alternative that people can think about?
Yeah, you'd need to then go into the mid-tier space, which is fraught with danger, because generally those mid-tier guys, unless the commodity price is really quite high, which copper hasn't, sort of pulled back a little bit, but continues to stay high, you lift up the risk curve. So there are some ones, A1 Mines, A1M is quite an interesting one. We cover that one as well. There's a very small one which has just done a reverse takeover in Mount Isa, AR1. That's an interesting one. Also, I've got some shares, and that's about 4.5 cents. So I think you got to be a little bit careful. I would steer people towards Wire, which is the global copper ETF, through Better Shares, and I think that would be a better exposure to clients. Would be the global ETF, which is diversified. It's got Antofagasta. It's got a lot of those big guys in there. I think that's something that would be worthwhile looking at.
And I guess those who haven't got much of exposure to resources could think about that. I think the Beta Shares one, QRE, which gives you
Yeah.
a whole lot of the good names all in one place and gives you
Yeah.
diversification. Probably won't get the big gains, but you'll tap into any solid return of resources.
Well, especially if the commodity prices do continue to move, then there's that constant buying that comes in. And as you say, BHP at $45. What happens when it gets to $50? Generally, that's the time where we probably put the sell button back on BHP and sort of start lightening a little bit. Maybe this time's different, but yeah, that's sort of that, coming back to 45, 50 is probably where you start to lighten a little bit of the BHP.
Okay, so about 9 months ago when BHP was about $34, I used to make the case, well, it's a classic case of a quality company being built up by the market short term. Eventually things will change and it'll come back. Now, similarly, I'm asking the question now, have these great tech companies of ours fall into that sort of category? Like you might buy them today and it might be 7 months' time, you say, oh, Switzer got it wrong. But I think in probably 12 months' time or 2 years' time, you'll be really happy you got, particularly when you look at what the analysts are saying. I think next DC, about 50% upside on a consensus view, X zero, about 75%, even higher. So let me just run through quickly about your personal views. Next DC, do you see that being in the buy zone now?
Yeah, especially with that agreement with OpenAI for a $7 billion infrastructure build. Yes, absolutely. It's going to take some time for that to go through, but certainly Next DC looks like good value here.
Right. Zero, why did apart from the fact that it's arguably one of our best tech companies and tech's been sold off in the US, if you put that aside, was it that $3 billion purchase of a US company that really gives them a great small business database? Was that one of the reasons why they've given Zero a kick in the pants?
Yeah, like, we had the sell-off in the US, so we were always saying, "Oh, well, the US is selling off, so that's probably the reason for it." The US has bounced, right? The US has bounced, and those tech stocks are starting to move higher, whereas we continue to get sold off.
Yeah.
I think our tech business or tech stocks are very, very good. Certainly something like Zero, there's a digestible that asset that they need to digest, and that's going to take some time. So potentially that is one of the reasons why it hasn't done so well. I just think that also Zero is playing in that US space, and I think the market is just undecided whether it's going to be a positive one or a negative one. You're going up against some very large businesses in the US, which have got that market sewn up. So I think there's a little bit of selling and a little bit of unsure of how that is going to work in that US expansion. And so maybe a little bit of profit coming off or the money coming out of the stock just until they can get some clarity around that US expansion and how it's going.
Okay, technology one, would you risk your money on TNA?
Yeah, yes, I love it. It's one of the most boring tech stocks in Australia. However, it has really come off the boil, and I got some clients that have got some very large positions in it, but also capital gains issues in there. And when it started to turn at that sort of $30, $29 breaking that 30, I bring them and say, look, how about we take some money off? And they're like, no, I want to stay in this one. I love it. I want to be here. And they're quite comfortable with it. Their buying prices are sort of $2 and $5. So, it's hard to
Four things.
it's hard to get them to get rid of some. I think TNE's one of those ones that will surprise us to the upside in the next reporting season, and I think the market's definitely just throwing the baby out with the bathwater on this one, and it is a good value buy down here.
Okay, what about WiseTech?
We actually had Richard White Inside Shores on Friday, and we sat down with him and quizzed him for a good hour and a half on the entire business and how it's going. Now, he had his CFO with him, he had his CEO with him also, but every time they spoke, to be honest, we just pointed our question back to Richard, right? So because everybody wants to know what he's got to say. But if you take away the governance side of things and what's happened, the actual business is a cracker. And the actual business is, and with that acquisition E2 Open, I think it was the new acquisition, it basically gives the entire value chain in WiseTech's hands. And in fact, WiseTech is now talking about governments buying into their technology, not businesses, but governments. So the New Zealand government is actually trialing so it can find or it can logistically see every package moving in and out of New Zealand. Now, if we're talking governments now starting to use his product, not just companies, this is a massive area that can continue on. Get rid of the governance. The business is very, very good. And it's probably my number one pick for next year. I hadn't seen Richard White and the business previously, but he was very impressive. They were very impressive. They knew everything. And this thing, if it does get a bit of a wriggle on again, I think UBS got a price target 115 on it. You could somewhat see you could nearly double your money at these levels. So yes, it's a buy.
Okay, so we might think about making a stock market TV program called Everyone Loves Richard. Love's been really important for Richard. All right. Some old-fashioned tech companies, CAR sales.
Yeah, I think it's been left behind a little bit. Seek and car sales. I think it's been left behind. The market's looking at the newer tech businesses versus the old ones. I look, if you got them, I'd hold on to them. There's no issues there. I just think the value from the new tech businesses are going to far outstrip that. So I would be cautious on car sales as well as Seek if you were going to ask me that on the next one.
REA.
REA. Well, now that looks interesting. I think REA has been sold off, and certainly rightly so, been sold off. But there's only two players in this space. We know the US guys have come in and taken over Domain. They're going to be putting some money towards it. But I was actually looking at some of its counterparties. An interesting business in Scandinavia called Hemnet, which has also been sold off, and it's a very much of a real estate.com business, but for Scandinavia, um, been absolutely sold off. These guys, like REA, have the ability to pull the levers on the yield. So, in other words, they can raise their prices, and people will still continue to pay it. Now, our market obviously has been a little bit softer with potentially interest rates potentially going up next year. So, I think that's got to be something that you need to put into your investment thesis. But certainly REA is looking very, very good down here. And it is one of those ones that is a master of its own destiny, and it can continue to pull those levers if it needs to. So I suspect the yield will continue. The market, the brokers are downgrading it with the stock as it comes down, but I think that will turn around sometime. And I think it's, yeah, definitely worth, I think it's $180 at the moment or something like that. It's probably the lowest it's been in a long, long time. So I'm definitely going to be starting to, in the new year, putting REA back into clients' portfolios.
One final one, I know you like it, 360, Life 360.
Yes, I love it. I actually looked at the chart today and it's right on support. The last time it hit this level, it rallied 20% within 4 days. Now, is it going to do it again today or sometime? I don't think so. We've got lighter volumes coming through with the holiday season, the holiday period. So I think it'd just be a little bit careful on Life 360 here. If it breaks this, and Michael Gay will probably be able to tell you a little bit more, but if it breaks this level, it's going lower. But if it holds here, it should be a clear signal to buy. So I'm going to be putting that again on the watch list for the new year. Let the dust settle, get back into it. But yes, Life 360, fantastic business and will continue to do well. It's just on support here. So I'm a little bit nervous to be putting my buy or putting my toe back in just yet.
Okay, mate. Well, fantastic. Thanks very much for your contribution today and for the whole year. Um, I know I talked about a TV program called Everyone Loves Raymond, but I really should be Everyone Loves Adam Dawes. Great guy. Thanks for joining us,
Yeah,
mate.
great to be here. Thanks so much, Peter.
And that was Adam Dawes of Shaw and Partners. And now let's catch up with Jun Bei Liu of TenCap to see what she thinks looks like fantastic value for 2026. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
Okay, now we're getting close to Christmas and people want a gift all the way from TenCap and Jun Bei Liu. So what's the greatest stock gift you can give to our viewers and subscribers?
Okay, the greatest stock gift, I would say for for next year will be actually, can I have a think about this one? There's many of them. Okay, so I think the greatest stock tip for the next 12 months is really Life 360. I think it's fallen a lot. I know it's a growth company, and I know at the moment they're out of favor. But this is one company that truly is growing rapidly, and it's reached this inflection point where the paying subscribers are now growing very, very fast. So and this is not to mention its advertising per subscriber is now picking up. So there's a lot of growth opportunity, and it is really on Christmas buy sale at the moment.
Okay, so have you always held 360 and you're adding to it as the price becomes more attractive?
Look, when we hold these companies, is that when they've done really well. So remember when they reported in August, we held the stock, it's done really well. Then we trim it back to a smaller position, just so that we take some profit, we can put into the next company that's coming along. Maybe it was Domino. So, and then now it's become smaller and share price fallen, and we will buy more.
Yeah, and I guess this is part of your investment strategy, isn't it? That if you've got a quality company that the market, for short-term reasons, decides they want to sell off, well, that's your signal, your flag to say, better buy it at when it's a good value.
Yeah, that's right. So this is because our strategy has the opportunity, flexibility to do that. We're not limited to whether it's growth or value. We can just buy when there's opportunity. So because we're active, because we can take profit, that gives us space. So when they do become cheaper, we can buy more of it.
Yeah. So on that subject, because I was talking to Adam Dawes earlier, And I said to him, let's go through some of the tech companies that have been really smashed up. And 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 I made the point that, and you would recall maybe 9 months ago when BHP was around $34, and I said to you, I know it's not popular now, but in a year's time, is it still going to be 34? And you said, no, it's going to be in the 40s, and it's exactly what it is. And I feel as a lot of these tech stocks are really cheap now, but eventually, like for example, if we if we start forgetting about the AI bubble, a lot of these tech stocks will be reloved, and so they look like great value to me. Is that pretty sound thinking?
Oh, absolutely. I think this is what many investors are thinking. It's just too fearful to jump in at this stage. My view is that, look, December is always, we're so close to the year end. Of course, there's not going to be new money put into those companies. So whoever is selling, taking some profit, close the year off, is going to see a bit more pressure. It's the tax loss selling, right, in the US market.
Yeah.
So, I do think January usually is a very strong month. That's when people, get positioned for the rest of the year. So they will get a pretty good support in January.
Okay, so next DC, buy or not?
It's a buy. Next DC incredibly actually has won so many contracts, including with OpenAI. I actually thought that's such a positive announcement. It's just not reflected because of this AI fear.
Zero.
A zero is a buy, share price down meaningfully on actually pretty good earnings. I think its acquisition of Melio is showing that Melio is actually doing pretty well. Pretty well. I do think that will come back.
A boring tech one in Technology One.
That's a buy too. I think I feel like all these companies, they all very high quality businesses, and everyone's thrown them out with the whole fear of the whole sector's being sold out. Technology One delivered very good results. In fact, they are actually themselves using the AI tool, implementing into the next product launch, and they are actually seeing growth accelerating into next year. So I think it's an incredible buy. Share price rebase, fallen quite a bit. With earnings is still accelerating, I'd be buying it.
Wise Tech.
The buy stake is a buy. They actually have shown people how quickly they implemented the price increases, and the price increase is actually quite meaningful. You will see the first half result pretty good into the runway into second half being very strong.
Okay. Now we're getting to less sexy tech stocks, car sales.
I think car sale is a buy because all of them has come off the classifieds. It's cheaper than it was, and near term the earnings fine. It will grow double digit for the next, 3-4 years. The only thing I wasn't 100% sure, the reason I hesitated is because there is the threat of AI, but if we forget about it, there's no issue. Because car sales is a little bit more exposed because they are in many markets, not just Australia. Their market position less strong in the US. So, whether it will get, disrupted over there, not 100% sure yet. So that one is a little bit unsure, but I do think that, for the near term, the impact is not going to be there.
Okay, finally, REA.
REA is a buy. I actually think the AI threat is so overplayed, ridiculously overplayed. This company controls a majority of the inventory here in Australia. They just done a deal with the OpenAI, and I think that this company controls its destiny and it has very strong pricing power. I know the listing is a little bit weaker because no interest rate increase. No interest rate cuts for this year, and maybe next year we won't get any. But I do think that the housing cycle is about to turn, and the listing should follow. Combined with its listing yield power, the company is still going to deliver pretty positive growth.
Okay, so next DC 0, Technology 1, Wise Tech, car sales, REA 360 will become the Jun Bei Liu portfolio because all of them are low prices. And as you know, one of our dear viewers once christened you Jun Bei Liu, but that's what you do. You look for quality companies at low prices, and they all fit the bill nicely.
They do, they do. They fit the bill really nicely. And, it's pretty rare for us to see all of them get sold off. It's just a great buying opportunity. We saw this a few years ago. Remember, we were talking about all these names, and now it's happening again. It should recover as the market sort of, get over this for tax loss selling and, taking profit phase.
Okay. Well, Jun Bei Liu, thanks very much for your contribution this year. I know everybody who's watched this show have always considered you to be the gift that keeps on giving, and I thank you for that.
Thank you for having me. Have a great Christmas and have a great holiday break, everyone.
Yeah. Same to you, Jun Bei Liu. See you in January.
Thank you. See you in January.
And that was Jun Bei Liu of TenCap. And now let's catch up with Paul Rickard of the Switzer Report and see what Paul thinks looks like fantastic value now and in the future. And joining me for the last interview of the year is Switzer Report's redoubtable expert on all things stocks, Paul Rickard. Thanks for coming.
Thanks, Peter.
It's probably the nicest thing we've
It is the nicest thing you said all year to me. It's great to go out on a high.
Yes. Christmas gift. Thanks.
Christmas gift. Don't expect it for another 12 months.
That's right. All right. So our previous guests have really been on a unity ticket in liking tech stocks. They think they're oversold. And much like when we were big fans of BHP at $34, I think this is a classic example of quality companies being built up by the market for reasons the market understands, but maybe is not relevant to long-term investors. So let me quickly run through it. They're like NextDC, Zero, Technology One, WiseTech. Yes, even Richard Watt's WiseTech. Car sales. Car sales was measured, but they liked it. REA and Life 360. Well, that was Jun Bei Liu's gift for Christmas. Which ones of the, or do you think all those companies are worth considering?
Look, I think pretty well all of them are, Pete. I'm a little nervous about REA, but put that to one side. I think they're all worth considering. I mean, look, I think Zero, about $113 a day. It wasn't that long ago. It was doing a capital raising at $176 after getting to a high of about $190. So we've had about a 40% pullback, and really nothing has changed except the market has gone a bit cold on Australian technology stocks. And I think what it is, Pete, is it does say that the market breadth is a little weak in the sense that there is a rotation occurring, but people don't, for some reason, don't want to own what they perceive to be high multiple growth stocks. And how long that continues, I think, is the question. I mean, I like them, but you're going to have to be patient.
Is the artificial bubble story being more worried about here in Australia than, say, in the US?
Yeah, that's a really good question. I think I'm not sure whether the artificial bubble is really what's driving the current weakness in growth stocks. I think maybe fundamentally you might say yes, because people say, look, if the US implodes, as for sure our market will follow suit.
Yeah.
And so what do you want to sell now and lock in some profits? That there's probably part of that. I think the other thing that's occurring is that we are seeing increasingly this rotation of resources.
Yeah.
And so a lot of the fund managers are positioning there. And so maybe that we sort of worry about the bubble in the US. What do you sort of give up on?
Yeah.
And they're not selling, the so-called more defensives. They're not really selling the Telstras. They're not selling the banks to any major degree. And so they're really sort of saying, well, these are the stocks and high multiples. These are the ones that'll probably get hit the hardest. Maybe it's time to sort of ease up a touch.
I guess if I'm a fund manager and I've made a lot of money on CBA and I've got out maybe at 190 or 180, it's down, 155 or something like that now. I'm thinking to myself, well, this year could be tricky, so I'm happy to be in the growth sector of the future, not only resources, but they're probably also chasing some income plays as well, just to give themselves a bit of ballast in their portfolio.
I think there's a few people looking for that, Pete, and you've made the comment that whenever you've been talking about being a little more defensive, I think that's what we're seeing in some of the fund managers. They're looking at the fact that, Australian market had a good run, not as US markets had a fantastic run. It's still driving everything, but what happens if it goes a bit quiet? What does it mean for every other sort of growth asset? And so I think that's what we're seeing, Pete. So I don't think it's a fact that I don't think they're saying Zeros and Next DC and Technology One and WiseTech can't profit in the AI revolution. It's more saying that if the AI bubble happens and if the Australian market follows, where's it going to be? Which
That's
thing
what
we're going to
I'm
be hit,
doing.
right? Yeah, I think that's what they're getting prepared for, or what's at least they're taking a bit off the table, to give them some options.
Yeah. And I guess in many ways, my view is if you buy these stocks now, you may well lose 10%. But when they rebound, they will rebound big time, I think. Yeah, when the catalyst is there to say, oh, gee, we've gone too hard on these tech stocks. You know, as you made that point, 113 was 175 or something when it.
It was over 190. You did a capital raising at 176.
Yeah.
This the institutions poured into.
Yeah.
And now it's down to 113. So, and really nothing has changed in that company apart from the fact that we're 4 or 5 months down the track.
Yeah.
So
They did do that was it Melio? Was the
yeah, so there's capital raising to fund that,
Yeah.
but they were all happy to buy it at $176. So
It seemed like a pretty good buy, you know, from what I've heard. Anyway, so that's it. You had some hesitation REA. Jun Bei Liu was very supportive of REA. I think even Dawes was. But what are your results?
well, I think both REA and car sales to a lesser extent are getting caught up in a little bit around the sort of the idea that maybe their markets could be disrupted by AI.
Right.
I think time will tell on that one, but as well as AI being a great way to source information, effectively what they offer is a sort of comparison website. Sure, they've got all the listings and people have to be on the REA website and people pay the 7,000 or effectively the real estate agent pays on your behalf the $7,000 or so to list it and you've got to be there. But they're sort of saying, well, maybe there's another way to match buyers and sellers in AI. Not yet, but maybe 2 or 3 years down the track. And so I think there's a bit of that occurring also with car sales. So could they be disrupted by AI itself? I think the other companies just in a different category. It's not AI that people are worried about. It's the whole sort of AI overinvestment impacting them indirectly. So it's a different category with both REA and car sales.
What I liked this last week was the comment from Bill Gates, who basically said AI is the real deal. It's the big thing of technology of tomorrow. And he said some of the companies that have possibly overinvested, it'll show. But there are so many companies out there that will use AI to make their companies better. And I reckon like Zero, WiseTech, Life360, these are companies that will use AI.
Yeah.
Next DC and I guess Goodman Group, they're gonna be leveraging. They're the picks and shovels, aren't they? Of AI, and they could overinvest. But the bottom line is AI is going to really drive a lot of productivity growth, and a lot of profits, and therefore stock prices into the future. If we can overcome the bubble, and I suspect it'll be the reporting season in the middle of January for the US. There will be a make it or a break it thing for US stocks.
Yeah, I mean, I think that's sort of the second current quarter. Look, there's a lot going on. Maybe we've got to get through, a couple of some big employment data, and also the question mark around the tariffs and what happens there and the Supreme Court.
Yeah.
But you're right. I mean, expectations are pretty high, and the question is, these companies they're going to want to start to see a little more sort of translation into normal companies starting to actually see the benefits.
Return on investment.
Return on investment. There are lots of investment. Apart from sort of the big top 7, not a lot of return there for most of the users. Financial return, that is, so far.
Okay. One last question. I haven't prepared you for this, so cop it sweet, Paul. What's the Christmas gift stock for our viewers? What's the one that you think, this looks like good?
Yeah, look, I wrote a story on some income stocks that you can see today.
Yeah.
The one I think that's probably looks really interesting is Sonic Healthcare.
Yeah.
Now, a bit of a laggard, but look, it's a good little business. The stock's come up a long way. This is a stock that was $45 in COVID.
Yep.
It's now down about $23. pretty well all that's happened, of course, is the COVID sort of where they all made lots and lots of money during COVID,
Yeah.
and margins have been sort of crunched post COVID.
Yeah.
But it's shown a bit of a bubble. It's still growing revenue, and it's also been able to hold margin the last couple of periods.
Yeah.
So that's now,
Can we set a longer term? So we see where Sonic basically was 5, is it?
yeah.
Okay, fine. All right. So, okay, so it is below where it was before COVID, wasn't it?
Yeah, look, it is before COVID. So I think there's some value there. It's about 18,
Little
19
bit.
PE. So I think you've got some interest value, whether it's too early, but it is going to pay a reasonable yield yet. So I like that.
Yeah.
So look, that's more in the boring category.
I wouldn't have expected anything more exciting from you, Paul.
I think you have to be patient with a couple of these companies. I think the other one I'm looking at, haven't bought yet, is still, another one in that growth category is Pragmaticus.
Yeah.
Down today at about 230. It's getting more tempting. I think the question is when you get involved in Pragmaticus.
I'll be teasing you when it's $400. So you didn't get in. You didn't get in. All right, Paul, thanks very much for your contribution this year. I'm sure a lot of our viewers appreciate it. You have a great Christmas.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. As I said, this is our last show of the year. I'd like to thank you for being loyal followers and viewers. We now have subscribers up to 25,000 for the show, which is a fantastic benchmark to reach. And I want to turn that into 50,000 by this time next year. Once again, I thank you very much for being followers and viewers. And I wish you a very happy Christmas and holiday season. And we'll be back around January 10, I think it will be. And that's when I'll be happy to have a look at the stock market and see what looks like great value going forward. Once again, thanks for joining us. See you next year.